Welcome everyone to the final webinar of the mini-series run by WSP of the MPA's Sustainability Ambassador Network's Lunchtime and Learn webinar series. So my name is George Baker and I work in the Sustainability and Climate Change team at WSP, where we provide management consultancy services to the built and natural environment. And I'll be chairing this final session run by WSP. So for those of new to the Lunch and Learn MPA webinar series, the aim of these sessions is to essentially provide a quick pit stop on some of the engaging sustainability hot topics of today. And we run these sessions about once a month, and each is about 30 minutes long, allowing for 15 minutes of Q&As at the end. So today's webinar will be run by James Tapson on how to go about measuring your greenhouse gas emissions, the latest legal requirements, looking at the likes of Streamlined energy carbon reporting, also known as SECR, and then how best to take action. So James Tapson is a Principal Consultant in WSP's Sustainability and Climate Change Advisory Services team, and he has over 6 years' experience supporting corporate clients in quantifying and reducing their carbon footprints, and leads many of WSP's corporate reporting and sustainability strategy projects. James is the technical lead for WSP's SECR services and is currently working with a wide range of blue chip and boutique businesses to guide them through your first reporting cycle. So without further ado, I shall pass you over to the safe hands of our carbon SECR guru, James, to talk you through the latest on carbon reporting and how best to go about it. Over to you, James.
Thanks for that glowing introduction, George. Hello, everyone. Good afternoon. Welcome to the session. Just also to note that our colleague Taylor is running the webinar from her laptop, so throughout the session I might be getting Taylor to shift on slides and flick to the Menti questionnaire as well. So if we can flick to the agenda, Taylor, just so we can talk through what we're going to be discussing today. So as George said, I'll just firstly be going sort of an overview of greenhouse gas carbon reporting, why we undertake it, and the overarching principles that everyone should be following when they're developing a carbon footprint for a project or for a company. I'll then be sort of diving into the UK SECR regulations, which, as George said, is the Streamlined Energy and Carbon Reporting Regulations, which came in early this year. So a lot of companies are now for the first time reporting on carbon emissions where they haven't had to before. We're looking at why it's been introduced and the plans for that regulations and how you should go about responding to their requirements. We'll then finish up with a sort of look forward at the future of greenhouse gas reporting, some emerging trends from this year we're seeing in the industry, such as sort of carbon neutral, net zero, offsetting, and science-based targets. So that bit at the end is sort of a look forward as to what we're anticipating coming down the tracks in terms of carbon reporting. So if we can flick to the first bank of Menti questions, Taylor. Just want to get a feel of sort of who's in the room. So if you go to menti.com on your smartphones and use the code 761975. And just let us know what sort of field you're coming from today. There's a few options there around whether you're in consultancy, financial sector, academia, other. Good idea to understand who's on the call today and what field you're from. Great. So it looks like, yeah, most people come from a consultancy background today, but we've got a few from the different sectors: manufacturing, financial, academia, and a few from elsewhere as well. So that's really good to see that we've got a good spread of people in the room, but a lot of consultants on the call as well, which is good to see as well. Maybe if we can flick on to the next question then, Taylor, on the Menti pack. Also, just to get a feeling of sort of temperature check of the room to see how much knowledge people already have of greenhouse gas or carbon reporting. So whether you have no understanding, some limited understanding, whether you know it really well, or whether you consider yourself a carbon guru and you're a real expert on carbon reporting, just to understand where people are coming from today in terms of their level of knowledge. Okay, great. So it looks like most people are coming in with some understanding, but obviously looking to get a bit more knowledge out today, which is really good to see. Great, thanks for that, Taylor. Can we move on to the third question? So this one will sort of be running throughout the session, but if there's any particular questions you want answered today, please feel free to put this in now. If you've got any burning hot topics you want me to talk about at the end. So we'll be coming to a question and answer session at the end, but feel free to put in some questions now. George will be selecting a few out at the end to ask me. However, we'll also be flicking back to this question at the end of the session. So if any questions crop up throughout the session, feel free to wait to the end and put them into this Menti question once we get to the end of the session. Great, seeing some already questions going in already. That's great to see. So yeah, we'll come back to that at the end, but any questions you have now, please feel free to put in there, and that question will be live until we get to the next Menti question. So if we can flick back to the slide deck, Taylor, and So we can start the session off with an introduction to greenhouse gas management. So for those who are unfamiliar with greenhouse gas management, looks like some people have had some experience before. Just want to give you a brief overview of what we mean by greenhouse gases, what we mean by carbon, and how businesses are currently going about reporting their carbon impacts. So if we can flick to the next slide, Taylor. So there are sort of 5 key reasons why businesses might measure and report their emissions. The first one is to monitor performance. So this allows measuring your carbon impact allows companies to set reduction targets and report ongoing progress against these. This is becoming increasingly important for investors to see, who want to make sure that companies are investing in acting in a sustainable way and showing progress, and that companies are setting and meeting environmental KPIs as well as financial ones. So a lot of investment firms are now looking beyond the financial performance and looking at environmental performance as a key indicator of a sustainable and profitable company. So the next reason why companies might undertake a carbon footprint analysis is to identify areas for reduction. It's the old saying, you can't improve what you don't measure. And creating a greenhouse gas footprint allows you to find where you might have greenhouse gas hotspots, areas where you've got high carbon emissions, and that can then help focus your efforts for reducing those emission sources going forwards. The third reason is to drive cost savings. So linked to areas for reduction, reducing greenhouse gas emissions often goes hand in hand with longer term cost savings, whether that's by reducing energy demand and therefore reducing the bills that you pay to your energy provider, or whether it be through an initiative to reduce staff travel and use of teleconferencing facilities, then therefore driving down sort of expense claims through business travel. So that's how sort of reducing carbon emissions can usually go hand in hand with driving down costs for your business as well. The fourth reason, this is growing increasingly popular, is to communicate your impact and your progress to your stakeholders. So as I'm sure everyone is aware, there's been a massive rise in consumer and customer interest in sustainability. I mean, it's now a front page news, which is great to see. And many consumers now want to understand the credentials of companies and are starting to vote with their wallets and shifting towards only working with them and buying services and products from companies that they are seeing as transparent and are doing taking positive steps to reduce their environmental impacts, in particular their carbon footprint. As an example, a project I'm working on, HS2, the high-speed rail project linking London to the north of England. On that project, there's sort of a specification in the procurement practices that only products that have what is called an environmental product declaration, whereby sort of the environmental and carbon impact of a product is sort of listed. Unless you have an environmental product declaration for your product, HS2 actually won't procure that product for the project. It's a really good example of where procurement practices can help drive down carbon emissions. And actually, you couldn't sell your product into that project unless you had produced an EPD, environmental product declaration, that stated how much carbon was in your product. The fifth reason, and was sort of probably the driving force for maybe by some of you on the call today, is legal compliance. This is probably the most obvious one. And in the UK, mandatory greenhouse gas reporting has been around for quoted companies since 2013. But SECR, which was introduced earlier last year, has been significantly expanded to cover a larger spread of organisations. So we've gone from around 3,000 organisations reporting under the previous regulations to now I think 11,900 government estimates need to be reporting under the new regulations. So that's sort of the 5 reasons why we might go around collecting and reporting carbon data. So if you flick to the next slide, Taylor, if you just show the picture as well. So when we talk about greenhouse gas emissions, we're not talking just about carbon dioxide. The term carbon is used as a proxy for all 6 key greenhouse gases listed here. So there's carbon dioxide, there's methane, nitrous oxide, HFCs, PFCs, and SF6. All of these are lumped together when we talk about greenhouse gas emissions. And when they're reported, they are reported in terms of their carbon dioxide equivalent unit, so a CO2e unit, and it's used to compare the emissions from various greenhouse gases on the basis of their global warming potential. For example, methane has a global warming potential of something like 25 times that of carbon dioxide, and therefore its global warming potential is 24 times higher than that of carbon. Based on international best practice, which comes from the Greenhouse Gas Protocol, which is the sort of corporate standard we all sort of follow when we're doing our carbon footprinting, businesses usually report their emissions under 3 scopes. So you might have heard of Scope 1, Scope 2, and Scope 3 before. So Scope 1 emissions are your direct emissions generated by the business through the combustion of fuel in your operation or in vehicles that you operate. So if you have a boiler on site that burns fuel directly, or you have a fleet of trucks, or you own aeroplanes that burn fuel directly, those are your Scope 1 emissions, where you're directly burning fuel and creating emissions. Scope 2 emissions are indirect emissions, usually from the purchase of electricity, heating and cooling, whereby someone's sort of burning fuel on your behalf and you're getting the benefit from it. So where you're paying for electricity bills, where you're paying for heating bills, those are classed under your Scope 2 emission sources. So those are the two scopes that businesses typically most report on, as you usually have a good set of primary data you can get from your energy providers and from your own operations. And that's typically what businesses have been reporting on and setting targets on for the last 10, 15 years. However, Scope 3 is becoming much more prevalent now in how businesses are reporting their carbon footprints. And Scope 3 encompasses your upstream and downstream value chain emissions. So that could be energy used by suppliers of yours to produce the products that you buy. It could be the transportation of those products to your warehouse, to your facilities. In terms of those are sort of upstream emissions. There's also emissions that your staff might directly cause. So that's whether they're commuting to your offices. Business travel that they undertake as well also counts as a Scope 3 emission. And then looking more downstream, if you're transporting or distributing products from your offices or from your warehouses, any use of those products that you sell. So for example, if you manufacture TVs, the use of those TVs, and then looking at the end of life of products, how they're disposed of and how they're sort of treated at their end of life also comes under your downstream Scope 3 emissions. Scope 3 reporting is typically voluntary. Under SECR, I think only one Scope 3 needs to be reported, which is business travel. But many large businesses are now seeing the wider value in reporting these emissions, particularly with the growing participation in certification schemes such as CDP, which was originally called the Carbon Disclosure Protocol, and also GRESB, which is a real estate benchmarking protocol as well. So Scope 3 is becoming much more prevalent in how businesses are looking at encompassing in their total carbon reporting boundaries. So if you look onto the next slide, Taylor, just to sort of go over the core basics of how we sort of work up a carbon footprint. At its core, carbon calculation is relatively simple. It's simply activity data multiplied by a greenhouse gas emissions factor. So activity data is simply your business operations data. So this could be a kilowatt hour of energy that you take from your energy bills. It could be a kilometre travelled by your employee in a car, taken from your expenses system, or a spend on office supplies from your business, a spend on paper or printers, for example. The emissions factors are predetermined ratios of the amount of emissions that are generated per unit of activity data. For example, a kilogram of carbon dioxide equivalent, which I discussed earlier, per kilowatt hour of energy used, or a kilogram of carbon dioxide equivalent per kilometre of business travel undertaken in a car, for example. So in the UK right now, as an example, the UK has an emissions factor for grid electricity usage, which is roughly 0.25 kilograms of carbon for every kilowatt hour of energy that you use through your grid connection in your office or in your home. So in the UK, the government produces a pretty comprehensive set of factors that we use every year for corporate carbon reporting. So that if you log onto the UK government website and look for carbon factors through the BEIS portal, there's a whole list of those that get updated every year that cover a multitude of things from fuel usage to business travel to purchase goods and services to waste. So the whole sort of Bible of carbon emissions factors on there. And then internationally, the International Energy Agency and the Greenhouse Gas Protocol also produce some international factors for other countries. Then simply put, the activity data, once you've collected that, multiply that by the emissions factor once you've collected that, and you total up your carbon footprint. So activity data multiplied by emissions factor, and you get your carbon emissions. So if you flick on to the next slide, Taylor, there are sort of some 5 guiding principles that I sort of recommend that everyone takes when undertaking and developing a carbon footprint for a product or a service or for a business. You want to make sure that your carbon footprint is relevant. Ensure that the data you're collecting, reporting appropriately reflects the greenhouse gas impacts of your organisation and serves the decision-making needs of its users to make sure that stakeholders and people within the business can understand what you're talking about. Completeness. You need to quantify and report on all sources of greenhouse gas impact within your reporting boundary, and you need to make sure the reporting boundary is defined well, and that you disclose and justify any exclusions. In most cases, a lot of businesses won't have information on certain emission sources, and so it's perfectly justifiable to exclude those, but you need to make sure you're really clear as to why it's been excluded, whether it's because there's no data on it, you think it's very small, and so you need to make sure that that's really well justified in your explanations. You need to make sure that your reporting is consistent. So you need to use consistent methodologies year on year to allow for meaningful comparisons of environmental data over time. You want to be comparing apples with apples. You need to document any changes to the data. You need to document any changes to your organisation and your methods, and if any sort of carbon factors have changed as well. So you can compare like for like year on year and show progress. You need to make sure that it's accurate. This is obviously a given. You need to seek to reduce uncertainties in your reporting where practical, and achieve sufficient accuracy to enable users to make decisions with reasonable confidence as to the integrity of the data that you're reporting. You need to make sure also that your whole reporting process is transparent. It needs to address all relevant issues in a factual and coherent manner. You need to keep record of all assumptions, calculations, methodologies used, where your emissions factors have come from, where the data's come from, any systems and processes that have been taken to get the data to you and put that into the report. And quantitative data will be greatly enhanced if accompanied by a description of how and why the data was collected. And as I said before, it's really key that assumptions and justifications are really well written so that anyone essentially could repeat the whole process and get the same results. So if we flick on to the next slide, Taylor. So now that's hopefully given you everyone a sort of quick run through of what we mean by carbon reporting and what carbon reporting is. We're now going to dive into the UK Streamlined Energy and Carbon Reporting requirements. So if we flick to the next slide, Taylor. So SECR is essentially the new reporting framework for businesses operating in the UK to report energy usage and carbon emissions. It was developed following the 2016 summer budget, where the UK government consulted on a review of the business energy landscape and recognised that we need to start making some rapid improvements to help meet our carbon reduction targets as a country. So it was brought in to improve and simplify the energy framework, aims to encourage business to take more action. So businesses are now going to be quantifying their carbon footprints, therefore they can take action to reduce it. And it helps, as I said, contribute to the wider government targets to reduce carbon. So if you flick to the next slide, Taylor. The reason why it's changed is before the business policy framework was quite complex. There's a number of different regulations that people could have been in the scope of relating to the energy use and carbon emissions. And SECR has sort of been brought in to simplify this through 3 key changes. So it increases the scope of the previously existing mandatory carbon reporting regulations, which only applied to quoted companies. It updates and replaces the carbon reduction commitment, the CRC, after its closure at the end of 2019. However, the revenue from the sale of allowances under CRC will be retained by an increase in climate change levy. So those are sort of the 3 key changes to SECR and what previous carbon reporting you may have been undertaking. So there's a sort of a number of reasons, as I said, why the government has brought this in. So there is an anticipation that sort of through SECR being realised that there'll be a sort of a 4 terawatt-hour energy saving every year. That's about 80% of electricity used in the UK transport sector, and about 15% of Scotland's annual emissions. And substantial admin costs for businesses annually as well. So now they've put the streamlined process in place. And they're also anticipating a major monetary benefit between now and 2035. So if we flick to the Menti questions, Taylor. Go to the next question. I think we've gone too far, Taylor. One back. There we go. Okay, so yeah, so this is sort of a big quiz for everyone in the room, just to sort of understand people's knowledge on this. So the UK government has anticipated there'll be a net societal benefit from the introduction of SECR between now and 2035. So if you flick back to menti.com on your phone and answer the questions, how much do we think that the UK government thinks that SECR and energy and carbon reporting across the UK is going to benefit the UK in terms of net societal benefits? This is due to air quality improvements, this is due to less hospitalisation, due to reduced climate change, this is due to reduced sea defence walls need to be built, climate change is being reduced. There's a whole host of reasons why the government thinks we're going to be saving money in society through driving energy and carbon improvements. Great, so it looks like most people think it's around 1.5 billion. That is the correct answer, so well done. Looks like the majority of the group had that one right, so well done everyone. Flick to the next question as well. Yeah, so this is sort of wider question, another quiz for the room. What percentage reduction in net carbon emissions is the UK government targeting by 2050? So do we think it's 50%, 70%, 80%, or 100%? It looks like most people think it's in the higher brackets, around 80, 100%. Okay, so those of you who put 100%, well done. So the UK originally did have a target of 80% by 2050. That was the original target. So for those that chose that, I can see why you went with that. But Theresa May, in sort of one of her last acts, actually introduced the net zero, so the 100% reduction in carbon emissions by 2050 during 2019. You might also have seen the recent good news that came out this week that the UK will be upgrading its interim nationally determined contribution to reduce emissions by 68% by 2030. It was originally 53%, so it's really good to see the UK government stepping up its interim targets, and now really sets us up as the UK as one of the leading carbon reducing nations globally, and sort of builds into this narrative of why we really need businesses to really take this by the horns and deliver their carbon savings through things like SECR and wider initiatives. So if you flip back to the slides, Taylor. So this hopefully gives you a brief overview of whether your business may or may not be in scope of SECR. I'm sure a lot of you will be interested to know. So the SECR framework will only apply to companies formed and registered under the Companies Act 2006. This means that organisations which are not registered, so some public sector organisations, some charities, and some private sector organisations, such as certain partnerships, will not be in the scope of SECR. For quota companies that are registered under the Companies Act, the simple answer is yes, you'll be in scope. You would have been in scope of the mandatory carbon reporting regulations previously, and you're in scope of SECR. If you're a private company or an LLP, whether you're in scope depends on the size of your business. So if your business has more than 250 employees, an annual turnover of more than 36 million, or an annual balance sheet greater than 18 million, if you hit two of those thresholds, then you are in scope and you're counted as a large company under the UK Government Companies Act. The government anticipates, as I said earlier, this will probably affect around just under 12,000 companies, 230 LLPs and 50 unregistered companies, which is around a 7-fold increase on how many companies had to report previously. So a lot of companies for the first time will now be calculating their carbon footprint and reporting on emissions, and this will be disclosed publicly. So it's a public record. It sits alongside your public accounts. And so it's something that companies need to take seriously, as companies will now be judged on their performance, because it will be a public record of their carbon emissions. So if you flick to the next slide, Taylor. There are some exemptions for some companies, and they wouldn't have to report if they met these exemptions. So if you're a small energy user, so if you consume less than 40,000 kilowatt hours per year in your 12-month period, then you are exempt. As a guide, that's about the annual energy use of about 3 UK houses combined. There's also a comply or explain exemption, allowing unquoted companies to exempt a proportion of the energy use and emissions from reporting, provided they can explain why it would place a disproportionate burden on them to report it. The government also has an exemption that if a company feels reporting would be prejudicial to their business, they won't have to report in that year as well. I imagine that's probably only in the case of when mergers or acquisitions are being undertaken. So it might only apply for 1 year, but not for every year for a business. Importantly, businesses, if you feel you are exempt because of one of these reasons, you still need to submit a statement as part of your annual submission to Companies House to say that you are exempt, and you can't simply just not report at all. So flick onto the next slide, Taylor. So if you've decided your company is in scope and you need to be reporting on your carbon emissions, then depending on whether you're a quoted or unquoted company depends on what exactly you need to report on. So all companies will need to report on their energy use in the UK operations. So you can see, quoted and unquoted companies need to report on that. Importantly, it's just for your UK operations. It doesn't cover if you're a global business. It doesn't cover that unless you're quoted. So for unquoted companies, it's just your UK operations. So you can get that data from your combustion of gas, your electricity usage, get all that from your bills from your suppliers, and that needs to be reported in the kilowatt hour figure. You then also need to report on the carbon emissions from that energy use. So as I said earlier, sort of combining the kilowatt hour figure with an emissions factor for your gas and your electricity, and that will give you your carbon emissions from your energy use reported in the tons of carbon dioxide equivalent figure. All businesses also need to report on transport energy use. This is your scope 1 if you own and operate fleets of vehicles, or if you own and operate trains or planes or anything that consumes fuel in that sense. Again, you need to be collecting data on that and reporting that in a kilowatt hour figure. Importantly, just for unquoted and large LLPs, so not for quoted companies, you need to be reporting on your carbon and your energy usage from business travel, but only in cars. So anytime when a staff member is using a hire car or their own car on behalf of the business, you should be tracking data on that in terms of how far they've traveled, and then from that converting that into carbon. Companies also need to develop an intensity metric. So this is a ratio of greenhouse gas emissions against a quantifiable business metric. So this could be kilowatt hours per meter squared, or it could be tons of carbon per full-time employee that you have. It could be tons of carbon per product if you produce a product. So there's different metrics you could use, and it's totally up to you which metric you want to use. For quoted companies, there's also an additional requirement to actually report on all of your global emissions. So it's quite a much bigger task than for unquoted companies, and also energy use globally as well. Finally, all companies need to produce a narrative on what energy efficiency actions they've taken over the year. So this might be whether you've installed LEDs, whether you put a whole program in to reduce staff business travel, move to smaller offices, that kind of stuff to reduce your energy impact. So that will need to be recorded and show that you've taken action year on year. So move to the next slide, Taylor. So this is just a time frame for SECR. So the regulations actually came in April 2019, and it applies to your first full reporting year following April 2019. So for most companies who have a financial year reporting year, they probably should have finished their SECR data collection already. They probably would have reported it in the summer during their 18-19 submission. However, if you are a calendar year reporting year normally, it will the whole of 2020 will be your first reporting year. So you'll probably just be coming into the end now of your final month of that 12-month period, and you'll probably be submitting your SECR report as part of your annual submission to Companies House sometime early in this year. So you can see in the top right hand corner, there's different ways as to how you report your SECR obligations. So for quoted and unquoted companies, this will be in your annual director's report, so alongside your annual accounts that you submit to Companies House. For large LLPs, you can submit a standalone report if you don't submit the annual director's report, but both need to go to Companies House. And then charities might submit a combined directors and trustees annual report. And some companies may also submit a strategic report, but the majority, I imagine, will be submitting as part of the annual director's report that they submit as their annual filing to Companies House. So hopefully people have already been aware of SECR, but don't panic if you haven't already been collecting data for it. What I'd recommend is getting all available invoice and bill data you have for the past 12-month period, gathering data from your company expenses system for business travel, and where you don't have primary data, where you're missing data, I'd use industry benchmarks and extrapolation of verified historical data you have from previous years to fill significant gaps. There are some good benchmarks out there. The Royal Institute of Chartered Surveyors has a good sort of kilowatt hour per metre squared, if you don't know that for your offices. The Real Estate Environmental Benchmark, REEB, also has some really good data that you can use as proxies if you're missing some data for particular offices. So we flick to the next slide, Taylor. So here's just a simple 5-step plan for sort of completing SECR. So first of all, confirm your inclusion and scope. If you meet 2 of those 3 threshold requirements, carry out gap analysis and sort of project plan for getting all the data that you need. Collect the data for all of the different emission sources that are required for your company type. Calculate your energy usage and GHG emissions using the sort of process and principles I explained earlier, and then prepare and submit your report. As I said, that needs to be as part of your annual filing to Companies House alongside your annual accounts. So if you flick to the next slide, George. So this is where we're going to do a brief sort of run through the future of greenhouse gas reporting. So if we can flick to the next slide, Taylor. These are sort of the sort of 4 key areas I sort of really see taking off this year and also sort of going forward. So the first one is the growing importance of Scope 3. So as I mentioned earlier, we're seeing an increased trend of businesses beginning to account for, set targets on, and report their Scope 3 emissions. This is being driven by stakeholders wanting to see businesses take more responsibility for their upwards and downwards value chain and drives reduction from top to bottom. Also, for most service-based companies, so if you're in a law firm or a consultancy firm like WSP, Scope 3 would typically be the largest part of your carbon footprint once fully calculated. So it's important this is really well looked at and targets are set for reduction. For example, at WSP, we've been measuring our business travel, portion of our Scope 3 footprint on a global scale. And in 2018, this is actually 1/3 of our total Scope 1, 2, and 3 footprint. So a really big, important part that we're now helping, trying to deliver savings on as it's such a key part of our footprint. Another area that's probably really going to grow in the next few years is wider public disclosure. So we're seeing more and more of WSP's clients choosing to go further than just mandatory reporting and begin to voluntarily disclose under wider established programs to show that they perform well in GHGs and showing good reductions. The most well-established program that many of you might have heard of is CDP, formerly known as the Carbon Disclosure Project, where hundreds of companies, if not thousands now, are now disclosing their greenhouse gas and wider carbon and environmental data annually. By reporting to CDP, these businesses can gain competitive advantage. Public disclosure also helps you get ahead of regulatory and policy changes, identify and tackle growing risks, and find new opportunities for action that your investors and your customers, I'm sure, are now starting to demand. Many companies are also making their carbon reduction targets public and using the Science Based Targets Initiative process to validate their targets and publicly declare that their targets are not just sort of fingers in the air, but actually in line with the Paris Agreement requirements to keep global warming below 1.5 degrees. So I'd very much recommend, if a company is looking to set carbon targets in the future, that you check out the Science Based Target Initiative methodology for setting robust science-based targets. Third key area we sort of really see as growing is the importance of offsetting. Carbon offsetting you might have heard of. On the back of companies setting carbon neutral and net zero targets, offsetting has become an increasingly important issue and is becoming a lot more scrutinised to ensure it's being done properly. Many organisations are beginning to publicly report on how they plan to approach offsetting to reach their net zero targets. And it's important that if you're going down this route that you try to first reduce your emissions first. That's the key step in this carbon sort of journey, is that you reduce your emissions first as much as possible and then look to offsetting those residual emissions you can't get rid of. And ensure that any offsets that you do purchase come from verifiable sources. Example of a good couple of sort of verified sources are the gold standard and the UK carbon code. And also there's a website, VCS, otherwise known as Vera. So those are sort of gold standard and Vera, the two sort of online carbon credit markets that I'd worth recommending. I'd recommend to check out. Going forwards, it will become increasingly important that businesses report on how and when their offsetting was done and provide regular updates to show the offsets are still capturing and avoiding the emissions that they say they are. Finally, obviously it's an issue we can't get away from, but COVID-19. While COVID-19 has undoubtedly been sort of a massive tragedy this year and has impacted a lot of people negatively, it's actually potentially caused quite a positive in the environmental terms, in terms of delivering a short-term drop in carbon emissions due to less business travel, less people commuting into work, probably less production in terms of manufacturing as well. Many businesses will be considering how to report on these drops when they look back at 2020, 2021 as a reporting year in their carbon reporting in the future. In short, any reductions that you have realised as part of your business, whether it be due to reduced business travel, whether your office is being using less energy because you're not in it, are actual genuine emission savings, and you should be reporting those as such. The interesting area I think for the future will be whether businesses start to account for staff energy use from home. And if businesses start to pay for staff's energy use in broadband, for example, whether they start including those under their scope 1 and 2 emissions footprints. I'm hopeful that many businesses will see this as a positive opportunity to create this new normal that everyone seems to be talking about, whereby sort of we're hopefully traveling less, making less meaningless journeys, and actual savings that we're realizing this year are hopefully built in and sort of saved in future years as we move towards a more digital and sort of flexible working arrangement. Only time will tell on this. WSP actually did produce some thought leadership back on this back in June. So if you want to sort of head to our website, we did a whole blog on how greenhouse gas reporting might change under COVID and in the future. Well, that's I think the end of my piece. So I think if we can flick back to sort of the question 3 of Mentee Taylor, and I'll sort of hand over to George to sort of host and chair the question section.
Brilliant. Thanks very much, James. That was a very insightful and quick overview of SECR and some really interesting stuff, and I hope it was relevant to all listeners. So without further ado, we've got about 10 minutes of Q&A, so please feel free to enter your questions via Mentimeter. And I suppose I'll kick off with the one earlier on. Someone's put it in quite quickly. So how is SER different from ESOS? And actually building on that question, I suppose, because I know we've had a few clients ask, are you able to sort of streamline it together? Can you basically report ESOS and SECR at the same time? So yeah, if you could provide a little overview of ESOS as well, if that's all right, James.
Yeah, sure. So yeah, ESOS is the Energy Savings Opportunity Scheme. So this is sort of a wider EU initiative that's been around for I think 2 or 3 years now. So it's come before SECR. ESOS essentially is a sort of a looking forward approach. So it looks for opportunities to reduce energy usage, involves sort of audits on your site and flags sort of areas of key energy usage that you can try and reduce. It does not actually mandate reporting on performance and what's been done. There's an element of reporting, but this is only for a 12-month period. And so actually, sort of in contrast, ESOS is more to look forward, and it's sort of saying this is our current energy budget, this is what we're looking to reduce going forward, but you don't actually have to say if you've saved anything, whereas SECR is now more of the look back and saying, okay, over the past year, how have you actually embedded any changes to reduce carbon and energy over the year? There's also, I think, a slight nuance between what ESOS defines as a large company, and what SECR defines as a large company. So I think SECR, as I said before, is £36 million, whereas ESOS, I think, is around 50 million euros. So there's a slight difference in threshold. So if you're in the scope of ESOS, you might not be in the scope of SECR. So it's worth checking on that one. And the reporting timescales on both are slightly different. So you can't combine into one report. The way you deliver them is different. SECR goes to Companies House, whereas ESOS goes to its own sort of defined body. So although the data you're collecting for both is very similar, so I'd align the data collection process for both, the reporting mechanisms are quite different, and also the thresholds, whether you're in or out, are also slightly different as well.
Brilliant. Thanks for that, Looking just a couple of questions of asked if this, the webinar is recorded. It certainly is, and it's going to be uploaded onto the MPA's YouTube channel and their website. But if you also want sort of access to the slides and things like that, feel free to get in touch. I think either Ash from the MPA sent out some invites to get in touch with her, and she can get in touch with myself and James. And also if you accessed it via sort of LinkedIn links and things like that, we've got an SECR WSP page which has all our details to get in touch with us, and it also has a toolkit on there as well, sort of to provide some summary of what was provided today as well. So that's another way you can get in touch and we can share all the information. So yeah, moving on to another question. So I think someone's asked about whether sort of stakeholders are asking for information to be disclosed further, and can they do this through SECR, or is SER specifically for sort of carbon reporting?
Yes, SECR is just aimed at energy and carbon reporting. As I said before, it's only mandatory really to report on the things I mentioned earlier, so scope 1 and 2, and then some of scope 3. However, yes, the government is very much encouraging people to go further and report wider on scope 3, and sort of try and encompass as much as you can. I'd also, as I mentioned earlier, recommend if you have the desire to do so, disclose wider impacts through CDP. So CDP focuses mainly on carbon, but also looks at wider sort of governance and social issues as well. So I'd really recommend, if you wanted to show your stakeholders you're going further than just carbon reporting, that you start to look at wider disclosure under CDP. For real estate, if you're working in the real estate sector, I'd definitely recommend looking at the GRESB reporting structure, where you again can report beyond just the sort of mandatory carbon stuff to really encompass a full sustainability disclosure for your business, and again report year on year and compare like for like against people in your sector and in your asset class.
Brilliant. Yeah, that all sounds good. Moving swiftly on to the next question. Someone's asked if they're part of a UK-based group of organisations. Sort of, are they able to report, and should the parent company be reporting, or should they all be reporting? How does it work in sort of from a national perspective?
Yeah, so essentially the parent company holds the ultimate responsibility to report on SECR. As if you're a subsidiary within sort of a wider group, it's like that you'll probably need to provide data to the parent company. Therefore, if they're not already doing so, it'd be advised just to cross-check this with your parent company. However, companies, should those subsidiaries meet the thresholds themselves, they can go and report just directly to Companies House themselves, as long as the parent company is sort of aware of this. And so, yeah, you can either do it as a group report from the parent company that covers all their subsidiaries, but only if those subsidiaries meet the thresholds themselves. But the subsidiaries can also report on their own back as well. And also just to note, that's only just for UK part of the group. So as I said before, if you're not a quota company, you only need to report on the UK specific parts of your group that fall into those thresholds. And if one of your subsidiaries is smaller than one of the thresholds I mentioned earlier, they don't need to report, and they are out of scope.
Excellent. We've got a question about sort of scope 3, and then I think in contrast to scope 1. So how reliable is sort of the environmental input output of scope 3? And also, I suppose, methodologies, is it a little bit more difficult in calculating scope 3? And then could you also just give a few specific examples of scope 1 emissions in contrast?
Yeah, so scope 3, yeah, is very much sort of much more grey area than scope 1. As I said before, scope 1 usually have good primary data for it. It's from your boilers, it's from sort of fuel in your diesel generators, it's fuel in your car, so you know exactly how much is going in, and then using the emissions factor, you know exactly how much carbon's being generated. Scope 1 is the most well-defined one, I imagine. Scope 3 has been developing over the most recent years, as the question says. Sort of the economic input output model has been quite a common way that people develop initial scope 3 targets. So what you can do, anyone can use this, I'd recommend using the Greenhouse Gas Protocol Scope 3 Evaluator tool. So within that, it uses, as the question says, an economic input output model. So you can use spend data rather than actual activity data to try and get some initial carbon numbers. So you could, for example, can put spend data against products that you're buying. You could put spend data on business travel or on waste services. And again, this is very it uses quite a lot of proxy data, so obviously not specific to your company. So again, it's good as a first pass, those economic input output models, to get a good idea of what emission sources are material for your business. However, I'd use that as I said, as a first pass, and where you do have key emission sources, I'd go away and try and find primary data for that. But yeah, very much it's a good starting point to use those spend data and economic input output models for scope 3 analysis as a sort of materiality assessment as the first step.
Brilliant. Yep, no, that all sounds good. And then I think this one potentially can answer for ourselves, but do you think GHG reporting is as relevant for smaller companies? And I actually might add to this one, and for bigger issue for smaller businesses. And sort of what's the difference between the sort of net zero carbon neutral aim? I know a lot of big companies are saying they've become carbon neutral. What's the difference between net zero and carbon neutral, and is it as relevant for the smaller companies to report on?
Yeah, I think it is relevant for smaller companies as well. I think if your company doesn't meet those thresholds, but you're sort of just below, I'd still recommend as a good sort of sustainable company working in the UK now that it would be very much recommended to start collecting data on your carbon footprint, especially if you're scope 1 and 2. It's so easy to collect data on that because it comes from your invoices and your bills, and you probably do have some good data on your scope 3 around business travel and things like that. So I recommend every company to really start doing this. I imagine it's going to become mandatory in the future for all companies to start doing this, and so no matter what size you are, it's probably going to be part of the sort of business framework in maybe 10 years time. So it's probably a good opportunity to start now and have a look at your scope 1 and 2. In terms of the question on carbon neutral versus net zero, we're getting asked this a lot by clients, and it's very much a developing school of thought on this, but both carbon neutral and net zero targets or thinking follow the same structure. So essentially you define your emissions, you set a reduction plan, and then you offset the residual emissions that you can't get rid of. However, there are some differences between the two once you look in a bit more detail. So carbon neutral usually just encompasses scope 1 and 2, and then some selected material scope 3 emissions, if you're following the principles of PAS 2060, which is the sort of international standard for carbon neutrality. You then have to develop a carbon reduction plan, but there's no minimum reduction you have to achieve. So you could just show a very small reduction year on year, and then what you can then do is offset the residual. So essentially you can have a target for scope 1, 2, bit of scope 3, reduce a little bit, and then offset the rest, and then you can be classified as carbon neutral, and you can buy offsets that are avoidance offsets, so you can invest in renewable energy projects or renewable wind projects. Or you can invest in what we call carbon removals offsets, which could be tree planting or direct air capture technology. So that's sort of what carbon neutral means, around reducing emissions to a point, but no minimum threshold, and then offsetting the rest. Net zero, unfortunately, we don't have an international standard for it yet, and that's very much where the sort of confusion comes. However, the Science Based Targets Initiative are very much sort of developing the school of thought on this, and their sort of best practice sort of framework came out a few months ago in September, and they're looking to sort of solidify that next year. And essentially what a net zero target is going to be is you need to make sure that once you've calculated your emissions, that you're reducing those emissions in line with a maximum of a 1.5 degree global warming scenario. This, I think, roughly equates to something like 6-7% a year from 2020 onwards towards 2030 as an absolute reduction in emissions. And then any emissions that you can't reduce, that you can't avoid at the end of that pipeline, you need to be purchasing offsets that are purely removals-based offsets. So you can purchase avoidance offsets while you're on your journey to net zero, so the ones around renewable energies and carbon capture projects. But once you get to this sort of time of sort of saying you're achieving net zero, the carbon offsets that you're purchasing need to be all removals offsets. So that is tree planting projects, looking at maybe ocean algal blooming projects, and there's a lot of novel technologies being developed around actually directly capturing carbon from the atmosphere and then sort of solidifying it and burying it underground as well. So that's sort of the sort of nuances between carbon neutral and net zero. But I'd recommend everyone checks out the Science Based Targets Initiative paper on net zero if they're looking to set a net zero target in the future.
Brilliant. I'm conscious of time, so as a very final question, James, if you could sort of respond in a couple of sentences, if possible. As a junior, and Taylor, whilst James responds to this, we'll flip back to the final slide, and I'll just cover it. But as a junior project manager, what would be the sort of main takeaway from this presentation? And Taylor, whilst James answers that, are we okay to just flip back to the final slide of the presentation?
Yeah, well, I imagine, yes. I assume this person's probably working in a construction project scenario. So for me, it's really making sure you set a clear boundary around your project, what you're going to include, what you're not going to include. It's the key thing for construction projects really is looking at embodied carbon. So it's the carbon in the materials and products that you procure as a project. Typically, this is going to be the largest portion of your project. So being really clear with your suppliers and people that you procure from around getting carbon data from them. So I'd really sort of start the conversation with them around carbon and try and get a really good understanding of the products you're procuring and their carbon implications. And that's a really good place to start sort of driving down carbon emissions from there as a project manager who's in the sort of construction space.
Excellent stuff. Well, to sort of a final sort of comment on the general upcoming lunchtime learnings. So we're going to sort of hand over the baton to ACOM now from WSP to host in 2021. So the first one of those is going to be on electric vehicle infrastructure investment and the sort of transition of fuel. These are all provisional dates, but good to just have in the diary for now. So we've got one on the 3rd of February in 2021. We've then got another similar sort of electric vehicles session, again hosted by AECOM, and this is on the 10th of February, and that's on unintended environmental and social impacts of electric vehicles and their supply chain. Incredibly interesting. And then the final one is the natural capital and land optimization, still to be confirmed, but we're looking at something along those lines. So yeah, from us though, thank you very much for listening in. Thank you also James and Taylor for running the show, and thank you for the MPA for hosting us. And yeah, we look forward to seeing you all in the new year. Thanks very much.